I used to think picking stocks was how you got rich. I'd watch CNBC, see the tickers flying across the screen, and think, that's what smart money looks like. Traders shouting, charts everywhere, someone picking the next apple. So I tried. I opened a brokerage account and bought a few shares of companies I'd heard of. And for about 3 days, I felt like a genius. Then, the stock dropped 8% on some earnings report I didn't even understand. I panicked. I sold. I lost $127. Here's the thing. I wasn't investing. I was gambling. And that's exactly what the financial industry wants you to do, because scared, confused money is profitable money for them. Today, I'm going to show you the strategy that actually builds wealth. It's not exciting. It's not clever. You won't impress anyone at a dinner party, but it's how regular people become millionaires, not by being smart, but by being boring. Let's break this down. So, what actually is an index fund? Think of it like this. If you wanted to own a piece of the entire US economy, every big company you've ever heard of, you could go buy one share of Apple, one share of Microsoft, one share of Amazon, one share of Google, and keep going for 500 companies. That would cost you thousands of dollars in shares. And you'd have to figure out how much of each to buy. A nightmare. Or you could buy one thing that owns tiny pieces of all 500 companies at once. That thing is an index fund. An index fund is just a basket that tracks a list, an index, like the S&P 500. When you buy one share of an S&P 500 index fund, you instantly own a slice of 500 of the biggest companies in America. Apple, Microsoft, Amazon, all of them, one purchase. And here's what makes it beautiful. You don't have to pick winners. You don't have to know which company is going to dominate next year. You just own the whole haystack instead of searching for needles. Now, let me show you why this matters with real numbers. A study by J.P. Morgan looked at stock market returns from 1980 to 2020. 40 years. They found that 40% of all stocks suffered a permanent decline from their peak. 40%. That means if you picked a random stock, you had nearly a coin flip's chance of picking a loser that never recovered. But here's the kicker. The overall market, the S&P 500, returned about 10% per year on average over those same 40 years. The market went up, even though 4 out of 10 individual stocks got destroyed. How is that possible? Because the winners win so big that they drag the whole average up. Apple didn't just go up 20%. It went up tens of thousands of percent. And when you own the whole index, you capture every single one of those massive winners automatically. You don't need to find the next Apple. You just need to be in the room when it happens. An index fund keeps you in the room forever. Now, you might be thinking, okay, but what about professional money managers? The people in suits on CNBC, don't they beat the market? Let's look at the data. Every year, S&P Global publishes something called the SPIVA report, the S&P Indices versus Active Scorecard. It tracks how many professional fund managers beat their benchmark index. Over a 15-year period, roughly 90% of U.S. large-cap fund managers fail to beat the S&P 500. 9 out of 10. These are people with Ivy League degrees, Bloomberg terminals, and teams of analysts working 80 hours a week. And they still can't beat a boring index fund. Why? Because they charge fees. The average actively managed fund charges around 1% per year. An index fund, VTI for example, charges 0.03%. That's 3/100ths of 1%. On a $100,000 portfolio over 30 years, that 1% fee difference costs you nearly $100,000 in lost growth. 6 figures. Gone to some fund manager's bonus. That's not investing, that's donating. So what should you actually buy? Let me give you the simplest possible answer. 2 funds, that's it. Fund 1, VTI, Vanguard Total Stock Market Index. This owns basically every publicly traded company in the United States. All of them, big, medium, small, about 3,700 companies in a single fund. Fund 2, VXUS, Vanguard Total International Stock Index. This owns companies outside the US and Europe, Japan, emerging markets. About 8,600 companies, that's it. VTI plus VXUS equals you own the entire world. Every company that matters in every country that matters. 2 funds, total diversification. How much in each? For most people, somewhere between 60% US and 40% international, up to 80% US, and 20% international. The global market cap is roughly 60-40 right now, so that's a perfectly reasonable starting point. Or if you want to simplify even further, there's a single fund called VT, Vanguard Total World Stock ETF, one fund, every stock on Earth. Buy one thing and you are instantly diversified across every major company in every developed and emerging market. You literally cannot get more diversified than VT. Two funds, or one, that's the entire portfolio. Let's talk about what this actually means for your money. The S&P 500 has historically returned about 10% per year on average over the long term, roughly 7% after inflation. Let's use conservative numbers. Let's say 8% average annual return. If you invest $500 a month, that's about $16.50 a day into a low-cost index fund, earning 8% per year. Here's what happens. After 10 years, about $91,000. After 20 years, about $294,000. After 30 years, about $745,000. After 40 years, about $1.7 million, $500 a month. That's less than a car payment, and it turns into $1.7 million. Now, what if you can do more? What if you max out a Roth IRA, about $583 a month, and earn the same 8%? After 30 years, about $870,000. After 40 years, just under $2 million. This is not theory, this is math. This is what happens when you combine consistent contributions, low fees, and time. You don't need to be a genius. You need to be consistent. Now let's talk about what actually stops people. Because it's not the math. The math is simple. What stops people is fear. Every time the market drops, and it will drop probably several times during your investing life, you're going to feel it. Your portfolio might lose 20%, 30%, even 50% of its value in a bad crash. Your brain is going to scream at you to sell, to get out, to stop the pain. Here's the thing. The people who sell during crashes are the people who lose permanently. They lock in their losses and then miss the recovery. And recoveries are fast. If you miss just the 10 best days in the stock market over the last 20 years, your returns would be cut roughly in half. The best investors are either dead or they forgot their password. I'm serious. Fidelity once did a study and found that their best performing accounts belonged to people who had literally died because they never touched anything. The second best? People who forgot they had an account. Do not touch it when the market drops. Do not check your balance during a crash. Keep buying. Every month. Same amount. No matter what's on CNBC, no matter what your coworker says, no matter how scary it feels. This is why dollar cost averaging matters so much, which we covered in the last video. You're buying on a schedule automatically. Mark it up, you buy. Mark it down, you buy more shares for the same money. The system does the work. Your only job is to not interfere. Here's exactly how to do this. Go to your brokerage, Vanguard, Fidelity, Schwab. Doesn't matter, they're all fine. Open an account if you haven't already. It takes about 10 minutes, then decide. Roth IRA if you want tax-free growth. This is where most people should start. Regular brokerage account after the Roth IRA is maxed out. Now go to the trade or buy screen. Type in VTI, or VT if you want the one fund solution. Enter how many shares you want to buy, or better, enter a dollar amount. Most brokerages now let you buy fractional shares, so you can buy exactly $500 worth of VTI, even though one full share costs around $300. Click buy. That's it. You're now an investor. Then, and this is the most important step, set up an automatic transfer. Every payday, X dollars moves from your checking account to your brokerage account. Then set up automatic investing so that cash automatically buys more VTI or VT. You do this once. It takes 15 minutes, and then you never have to think about it again. Let me tell you what real wealth looks like. It's not exciting. It's not a Lamborghini or a Rolex or whatever Instagram wants you to believe. Real wealth is waking up at 55 and realizing you don't have to work anymore. It's checking your account and seeing a number that means your money is making more money than your job. It's having choices. The choice to quit, the choice to take a lower-paying job you actually love, the choice to travel, the choice to spend more time with your family. And almost nobody gets there by picking the right stock. They get there by being boring, by buying index funds every month for decades, without stopping, without panic selling, without trying to get clever. The S&P 500 has survived 2 world wars, the Great Depression, the 2008 financial crisis, a global pandemic, and everything in between. And over any 20-year period in history, it has never, not once, lost money. Not a single 20-year period, ever. The market rewards its patience. It punishes cleverness. Be patient, be boring, get rich. So let's bring this together. Index funds are baskets that own hundreds or thousands of companies at once. You buy one fund, or two, and you own the entire global economy. The math says most professional investors can't beat them. The fees are essentially zero. The strategy is automatic. The only thing that can mess it up is you, if you panic sell or try to time the market. So here's your assignment. This week, open a brokerage account if you don't have one. Buy your first share of VTI or VT. Set up the automatic transfer. Make it so you never have to think about this again. That's it, not complicated, just uncomfortable, because it forces you to trust a system instead of your own instincts. But here's what I've learned. Your instincts are terrible at investing. The system is boring and it works. In the next video, we're going to build your full portfolio, how to allocate between stocks and bonds, what target date funds are, and how to adjust as you get closer to retirement. That's where it gets real. If this video gave you a clear starting point, hit subscribe. We're building real wealth here, one boring, consistent step at a time. New videos every Thursday. We'll see you there.